Hello, and welcome to the CapLander Podcast, where we dive into the dynamic world of private capital markets. Whether you're new to private market investing or a seasoned professional, this podcast unpacks the latest trends, insights, and opportunities shaping the industry. Featuring expert guests and deep discussions, CapLander is your go-to resource for staying informed and inspired. Hi, Jody.
Hi, Morgan. So what's informing and inspiring us today? We've got a couple areas to cover.
I know something that's not informing or inspiring me, but it's unrelated
What
to
is
work.
that?
My washing machine's broken. It's driving me
Oh,
crazy.
no, right? It's such a bitch when life creeps into work and takes your, especially on a Friday afternoon, right?
I don't know why, but something about a washing machine unnerves me.
Yeah, it's like the basis of your comfort zone.
It is.
I wouldn't know because I don't really do laundry, so
When I went to college, I left you a Post-it note with the directions on how to do laundry.
yeah, you and your brother, this is where the detergent goes and other things. So fortunately, I know how to cover the private capital markets better than I know how to do laundry. So on that note, we publish a monthly newsletter / what we call a Thelander Digest, which was your brainchild.
Yep, it's been a couple years of running Thelander Digest. We have 3 issues that go a month, one for each audience. And of course, there's a lot of overlap in who's subscribing depending on what they are interested in. But generally, it's private company, investment firm, and then corporate venture. So maybe we just start with private company because it came from a client asking us if we had any information on skill sets that were paid a premium. And we added the question into the survey.
And it turns out, there's so much conversation around AI, and that was to me, a really smart thing. Even your grandmother, my mother, who is going to be 85 years old, was here the other day, and she said, "What's going on in AI?" And I was like, "Good for you, Mom." So everybody
Yeah.
knows about it, but I think that understanding the jobs and where people are having to pay more for jobs that are pivoting into AI makes sense.
We call it a pay premium. And in the survey, we asked what technical jobs do you pay a premium for? And it really covers software engineers and then data analysts and data scientists. That's kind of what we look at.
A data scientist is exactly the reason why it's important to highlight these pay premiums, because someone who's a data scientist could be working for a tech company or could be working for a life science company. And there's a lot of fluidness between the different sectors. So the pay premiums are important to understand because sometimes it's agnostic of an industry.
Yes. Well, especially because there's, like you said, there's so much talent that's moving across industries where,
Right.
what is it, like the medical device conferences are not called medical device conferences anymore.
Right. They're called
Med tech.
healthcare tech, yeah, med tech or big tech and bio or life sciences, tech bio, and
Right.
yeah.
Yep. It's very true. Well, to get into the private company newsletter, really, it's exactly what you would think that machine learning is the biggest premium for these data analysts, data scientists, software engineers. But the most interesting part about it is that actually, instead of software engineers, the maximum was highest for the data analysts or the seniors compared to the software
And
engineer.
so pay premium means that they're getting this above what somebody else is who could be in a comparable role just because the job is really hot. And do you think it depends on where they're located?
No, I want to say because top talent, you're paying top talent really regardless of where they are. But when you look at region, some job titles do have a difference for where they're located.
Yeah, but don't you think that that's because that's where the jobs are and not just because of the region?
It could be. I think it's so person specific. And it's just, I think a lot of it is based on where that person is and how desirable that person would be for the company.
Right.
So
So I don't think the location has anything to do with it. That's my opinion, is that it's a top person who's got a top skill set and the location is really secondary, if relevant at all. I mean, we just had this call with somebody who was in Oregon, and they were discussing this with us about how the different location makes impacts compensation and the talent. And I think it really just depends on what the competition for talent is in that area and how valuable that skill set is to your organization and whether you can replace them or there's a multitude of people who are available.
right. Well, we also talked about this with a client in the UK, right? A private company. And they were talking about having global talent too for executives and then staff level employees. So the median total cash, which is can be a combination of base plus bonus or just base, but the median total cash is about 190 for a lead principal software engineer.
Okay.
And
And is
then
this one that has a pay premium?
yep. So if for a software engineer who has a skill set in machine learning could be earning anywhere from ten to $135,000 more on top of that median total cash if they
Wow.
have skill set in machine learning.
That's a lot of money more. I
Yeah,
mean, let's
that is
face it,
more.
$10,000 is even more money, but if you're getting up into the 50 or $100,000 more, it's a
Right.
lot of money.
Well, and it's interesting too because I think well, I've read things saying that software engineers were such a hot job for so long, and now it's
Right.
not as much of a hot job. But I think obviously from these pay premiums, depending on which lane you're in and what you have skill sets in, that the machine learning AI lane, that's really where having knowledge about those systems in place is really where you can make more money.
Yeah. Well, we know that this is not going anywhere on the downward spiral anytime soon. So that's a good skill set to follow. Okay,
Right.
let's pivot now. We got that part. So let's talk about what's going on in venture.
Okay. And venture, we pulled a lot of exciting data for the March newsletter. And we get a lot of questions about obviously the compensation, but then when firms are putting additional infrastructure in place, like back office roles or
Right.
portfolio services roles
Because
and
a lot of
webinar.
times they outsource those jobs. So at some point they need to bring them in house.
Right. And that's really where you can see. So we looked at it by the total AUM, and we'll make sure to put the link to the digest in the chat. So if you want to look at all of the graphs, you can if you're a visual person. But really, what we were able to see is that firms with less than 500 million in AUM, 96% of them have somewhere between 1 and 5 partners, with over half of them having just one or two.
And AUM, just for those of you that are listening that might wonder what that nomenclature means, it is assets under management. So we consider under 500 million. That's not probably only emerging funds. It could be an emerging fund that had also raised a second fund, but still on the scale of a investment firm who could have 15 billion plus of assets under management, it is a little bit on the smaller side. So they have more partners than they have back office, is what you're saying.
Yep, exactly. And then it really, as you move up the AUM scale and you go from under
Right.
5 million, 500 to 999, and then a billion plus, is you have more partners. And then once you really cross that 500, the junior partners, the percentage of firms with no junior partners decreases as the AUM increases. So they
Wait,
have
the
more peers.
percentage of wait, say that again. So the percentage of junior
Firm.
partners,
Right. The percentage of firms with no junior partners decreases as the AUM increases. So
right,
as the
so
AUM,
you either rise to the top or you sink down lower because that title maybe have been inflated or you require to be promoted.
right. Well, this is probably a good segue into it too, because we put together the comp structures for investment firms. And Jody, maybe you can talk a little bit about what, when somebody comes to you and they say, well, I raised my second fund. I want to
Right.
look at putting carried interest programs in place. Here are my 10, I have 5 investment professionals and I have 5 back office roles. What is something that you see when people come to you and you look at the titles and you do the matching? Where do you see some discrepancies?
I mean, I literally just had a client meeting here in Miami about this week with a firm who's got offices in New York and in Miami, which is becoming more and more prevalent. And they're at that inflection point where they're raising more capital. And they have a mix of investment professionals as well as staff, and they never put in infrastructure. So they're saying, okay, we need to do this because we think we're paying people well. But now, since we have more capital and assets under management, the carry pool is changing. And all I can tell you is that no one size fits all, but it's a good time to make sure that you do something formal because you don't want to start to have turnover, especially in today's market where, as we know, there is dry powder sitting. So there's money that can be deployed. You are really looking for great companies, but you're being smarter about who you're investing in. And you do not want to have turnover in your firms. And just like you said, Good people are always in demand, even in a market that is a little tapped down right now.
Yeah. I think I was reading it was in term sheet. They were talking about how there's hundreds of unicorn companies. And there's been Wiz was acquired for billions and billions of dollars in an all cash
With
deal.
no revenue.
No revenue, right? It's like the same thing as Waze.
Right.
But you look at these and it's like, okay, good companies are raising money. Like Solaris was written about this week too. So companies are successful in this. It's
Right, and we just got a new private company client this week that's raised more money. I mean, we're getting these clients and we're seeing this happen, whether even if we're reading about it. But the reality is that the purse strings are always available for good companies. It's just that those companies are fewer and far between, and vetting them is getting to be a little more complicated.
well, what I've heard too, even from investment firm clients, is they're saying, well, we have the capital, like what you're saying, the dry powder, but we're also because we have companies that we have a majority stake in or we're the lead investor on, we're reserving a lot of that dry powder for
Add
the
more
company.
money to those companies, follow
Right.
on grants. I mean,
Right. Because
yeah,
none of these companies are necessarily geared towards an IPO.
yeah.
It's
Well, that
not
actually brings us to our next conversation. So, talking about like the CEO of Intel, who has now gone to a venture firm.
right.
And that's really interesting because it's just showing it actually proves the point because he's an engineer by training and the company Playground Ventures hired him, which is very interesting. I'm looking at the Axios article right now. So, there's two things with that. One is that it just shows you that investment firms do want to have people who are savvy at understanding companies because there is money to deploy. The mandate from the limited partners is even higher than ever. They want to see returns. So having operators is very helpful. And then he also talked about how Intel had spun out from the parent company, Intel Capital.
Right.
And that is sort of our third lane, which is the corporate venture firm. So I know you read something else in PitchBook.
I did. I saw that Thomson Reuters closed their second flagship fund, and that was with Tamara, who also joined us for a CVC compensation
Webinar.
webinar in the past. And
Yeah, I love that.
yeah, she was one of the Michigans. She
I
was
think she was
Michigan.
Michigan State. Yeah, because we were
Yeah.
talking about the Wisconsin stuff.
Yeah. But I think really they were talking about in all of the corporate ventures so interesting and what we talked about in the webinar, really what you talked about in the webinar from earlier this month was looking at the same thing you said with the investment firm side, that no one size fits all. And one of the questions that came in a lot in the chat was, well, what's the standard team structure? And what do people or what do firms do with long-term incentives? And a lot of the conversation with the lawyer on the phone, as well as the other industry expert from Echo Health Ventures, really saying that it depends on what your structure is. It depends on what the goal of the CVC unit
Meaning,
is.
what's the structure like Intel Capital that's spun out from the parent company so they have more autonomy? And they looked at some other Salesforce ventures and Google ventures that also have autonomy from the parent company. And those corporate
Can you
venture firms, per se,
can you explain when you say autonomy from it? What do you mean in particular for somebody who
so
wouldn't
they're
know
trying
or
to really, while they still are getting the money from the parent company, they have more independence and they are, I can't speak for them, but they're having more independence and that they don't have to keep going back for check writing. And they're trying to act, and they are acting in the investment firm ecosystem as true partners and investors, but they still have the strength of the parent company's skill set to be able to leverage to the portfolio companies, but they're more independent, like a true venture firm. The only difference is that they're not going out to raise the fund. They get the money from the parent company only, one sole LP.
a lot of those firms come in to the compensation survey and they don't click CVC, they click the investment firm because they don't think of themselves as corporate
They
venture.
think of themselves as venture.
Yeah, they
But
really don't.
regardless, I think what we're also seeing here is that there's a lot of consistency around that you want people in on the investment side who understand the portfolio company needs and also can distinguish like what seems like a really good company and founders, and also that it is a slower process because we keep hearing, I think we've mentioned this on almost every webinar, that it's the market's a little tight right now, but conversely we also just talked about a number of companies that are getting funded. So from our vantage point, we're seeing a lot of traction because we're busy. And it is also just this really elite group of firms and teams, and that part absolutely makes a big difference. And while these companies are growing, the last thing, and then I'm going to take a breath, is that there's also certain skill sets that you've got to know to be successful, because you want to keep people on your teams. And if you know that person could go to another company like AI related, then it's good to be aware of it.
Yep, I couldn't agree with you more. In terms of what we have coming, it's the end of March when we're recording this podcast. We have a number of lunch sessions that Jody and I are going to be doing together, focusing on investment firm, focusing on private company, shorter sessions than the webinars. They'll be 30 minutes instead of an hour.
I
And
think what
deep
we're seeing is that people want smaller bites of, because everyone's busy and everyone is interested in certain topics, and trying to do a broad sweep maybe in today's world is not as effective as spending smaller amounts of time and going more in depth. It's like workouts. I don't know, I've been looking at Instagram lately on all the workouts, because you've been telling me as I'm aging that I need to be lifting weights. So I've been watching all of this, and everyone is saying this, not just you, and that we need to eat more protein. So the reality is that you've got to work on parts of your body at a time. And it also translates to that holistic nature, that really business is holistic as well. And that it's good to focus on things like option pools or carried interest, and to
shaking my head,
understand that.
shaking my head. There's no way. I've been telling you for years. Weights, eat protein. No, 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 no. Truth
Yeah,
is
what
free.
doesn't taste as good as cake. So but we can't sustain ourselves, and things are taking longer. It's taking longer to see results, especially as we age, and these companies are aging, and the investment firms are also um, adding on.
Well,
What's that?
also adding infrastructure, but then also adding people. People move around. I mean, the Intel CEO moving into ventures, the perfect example. I mean, he said, I'm an engineer. I'm an
Yeah,
engineer by background. He signed 2 term sheets in his first week. And I think part of that is that when you have a background in something and you come into the innovation space and the private capital markets where innovation is encouraged,
right.
that you can see it from the operator standpoint and you understand it because you've been on the corporate side of it, which is everybody would tell you this from being in a corporation. It's slower, a lot of
Yeah,
layers, a lot of rules. I mean, going through getting a PO from a corporation, it takes time, a lot of
right.
different departments, a lot of different people to go through, a lot of different protocols.
Right.
Whereas in the investment,
Entrepreneurs want to be set free. They want innovation. They want to be able to make decisions. And that is why they're doing it, right? They have that spirit. They have the risk taking factor, and it doesn't scare them.
it's like unshackling somebody, and all of a
Yeah.
sudden you're like, okay, wait, I can just look at this and I have the autonomy to make a decision, to write a check. And especially when when you do have years of experience, to be able to have the perspective to say what you're doing is filling a void. And you, as the CEO or the executive, if you have the right team in place, then here's the money you need to at least get going or get
But
to
what
the
we see
next
is that
step.
all these companies and the firms, and maybe we wind up with this, everybody needs infrastructure. I hear over and over. One of our new clients this week was talking about all the webinars and all of the podcasts, this podcast, and all the resources actually are extremely valuable. So I'm glad
Right.
that we're doing this and recapping, because it's all tied together more and more in the movement from companies into investment firms and corporate venture into investment. And then also a lot of times you see that I know a couple of investors who are now running companies. The whole private capital markets is a mindset of that spirit of innovation and entrepreneurship. And it's something that cannot run without having some kind of order to it.
Yeah. Well, there's more formality because it is taking longer. Like you're saying,
Yeah,
people are
well,
doing
that's
it.
the Thelander business, right? That is why after almost 30 years, we're here, because we understand it and we keep putting in infrastructure and helping, but in ways that are not too specific, just enough to give guidelines, and then they can be adjusted and massaged to work for the specific client or company or firm.
Yeah, definitely no two products are ever the same. So,
That's right. And the
all
data's only
right.
as good as you know what to do with it. Those are all my mantras. So, all right. On that note, we hope everybody enjoyed the podcast. And we've got two more coming up, one on investment firm with a partner from Cooley. Yep.
Yep.
And then we've got another one from the VC perspective. We've got Michelle Park from NEA, which is great. So
Stay tuned.
Yeah. See you next time.